Good day, guys. Welcome to Forex Money. Today, we are on episode 20. We're going to be talking about hedge inflation. Now, let's start with the word hedging. Hedging is when normally it works like when you buy gold and sell USD CHF. Like you buy gold, you sell USD CHF. That's what we call hedge inflation. It's talking about taking positions in opposite directions. The other one is the buying of gold, the other one is the selling of USD CHF. So that is called hedging. Now, that's where the word hedging comes from. Now, hedge inflation is when you hedge inflation from the USD with the inflation on the CHF. That's what hedge inflation translates to. Remember, when you hedge is when you sell something else and buy something else, meaning that you buy the US dollar and use the profits that you get from the US dollar to and use it to sell the CHF. Now, in terms of uh, commodities, let's say you buy gold on one position, and in this gold that you were buying, on the other hand, you were selling the US dollar. The reason why you do that is because in case you lose money on gold, you will gain the money that you've lost on gold, you will get it on the US dollar, CHF. So that's how the hedge funds are protecting their money. They buy something that is, let's say, right now in a recession, gold is always bullish. It's moving in a bullish direction all the time because we are in a recession. It will go bearish at the end of the recession, but for now it is bullish because we're inside of recession. So we buy gold as a say. We buy gold because gold is our safe haven in case we lose money in selling the US dollar. We know that we will still have enough money in gold. So hedging is a way of protecting your money with uh, gold because gold is bullish in a recession, and we go and we risk our money by selling the US dollar. And in case things don't go well for us on the US dollar, we know that we'll still have enough money on gold. So that's what hedging translates to. So here in hedge inflation, what we are doing, we are not buying two different currencies. Hedge inflation in this case is when the inflation on the US dollar is doing well and the inflation on the CHF is not doing well. That means we're going to be offsetting our profits with the CHF because the inflation on the CHF is not doing well, and we buy the inflation on the dollar because the inflation on the dollar is doing well. So we know that we're going to make money by buying the dollar, and in case our trades in selling the CHF are not doing well, we know that we'll still recover our money from the US dollar that is doing well. So now let's move into hedging inflation. Let me explain how I we are hedging inflation. So this is the US dollar. You can see that the inflation in the US dollar is recovering at 2.7%. Let's go to Switzerland inflation. Switzerland inflation is not at is not anywhere near the 2% mark. It just recovered from negative to -0.1%. It is at 0.2%. The US dollar's inflation is at 2.7, and the Switzerland inflation is at 0.2%. It's not, it was supposed to at least be at 1%. It's not there, it's at 0.2%. So, what we're going to be doing is that we're going to be buying the inflation on the US dollar and using the profits on the US dollar to offset some of our profits with the CHF. So let's look at the GDP on the US dollar. The GDP is telling you that it is recovering at 2%, and the GDP in Switzerland is also recovering at 2%. So even though the GDPs are telling the same story, the inflation, on the other hand, is telling the opposite of what we have. So I talked about cutting interest rates, and I said interest rates are being controlled by the use of inflation. Interest rates are used uh, to control inflation. So now let's move into the interest rates. You can see that in relation to inflation, the GDP on the US dollar is steady. It's been steady since December the 18th, and the US dollar held its interest rates. Why? Because the inflation is doing well. It's actually recovering. So now in Switzerland, the inflation is not doing well. Part of the reason why these guys are continuing to cut interest rates, and I believe that at 0%, they will actually continue to cut interest rates. And let's look at the Fed. The Fed is at 4.5%, and Switzerland is at 0%. And they're gonna be continue. They will continue cutting interest rates. Why? Because their inflation is barely recovering. So the hedge inflation strategy is that we can see that one currency is not doing well in terms of inflation and interest rates, the other in the US dollar side is doing well. So we're gonna be let me show you, we're gonna be using the US dollar in this boom bust process that I'm talking about. When the US dollar is recovering, that will be here, is not now, it might happen next year, not now. So in this boom bust process that we're doing, we are trying to hedge the inflation in the US dollar and use some of the profits that we made in the US dollar. We use them to offset the losses that we had in the the CHF inflation. So that's what we're gonna be doing here when we trade the recovery of inflation in in the US dollar in this thing that we call the major bust. We're gonna be the US dollar will be recovering in the major bust that might happen next year, not now. At this point where the market will break out of the interest rate cut, uh, the correction level. So it's going to be breaking out. Why? Because we're going to be hedging inflation from the United States and using it to offset our profits on the CHF. So that's something that I had to explain to you guys about hedge inflation. So you can only do this system that we call hedge inflation. You can only do it when one currency like the US dollar is recovering and the other is barely recovering, which is the inflation that you saw in Switzerland, that is at 0%. So that's how you hedge an inflation from one currency. That's how we they apply the strategy called hedge inflation. So we're comparing this guy with this guy. You can see the difference 2.5% and 0.2%. So this guy will take time uh, before he gets to the 2%, the 2.7%, 2.7% of the US dollar. So these are the imbalances that we have in macroeconomics. And once you find those imbalances where one currency is doing well and the other has to catch up to get to the other currency, this imbalance that we're talking about is called an arbitrage opportunity or an arbitrary opportunity that uh, the banks are taking advantage of. The banks being in the mutual funds, your old mutual, your hedge funds. The reason why we have the word hedge fund, it comes from hedging. It comes from the strategy that they're using because they're hedging inflation from another currency, from another economy, and they're using it. They're using that inflation to offset some of the, the profits that they've made from the other currency. Meaning this guy is taking time to catch up with the other currency, which is a 0.2%. The time that it will take to get to 2.7% uh, on the US dollar is the arbitrary opportunity that we are taking in the trade that we are looking at here. So it won't happen now. It will happen next year when we wick, this part. And I believe that this manipulation of this low, where we're going to be going below this level down here, the manipulation will be much bigger, probably because the sanctions, the pricing in of the sanctions when the market's going to be dropping. Right now, we don't have anything fundamentally that is telling us to buy the dollar besides the unemployment rate that gave us a bit higher on the United States. The only thing reason that we have for buying this is that unemployment rate, but you cannot buy a currency based on the unemployment rate. Macroeconomics is telling us to sell the dollar, but price action is telling us that the banks are not willing to buy at this level. They need the market to, recover first before they sell it. They need to sell the market on its high. They need to sell it at a higher price. If they sell it at a lower price, they will lose money. So they need to push the market higher so that the hedge funds can come together with the banks and say, hey, guys, the market is at a higher price. Are you willing to sell the market at this price? If they have an agreement in selling the currency, then the currency will sell. Those talks that they have, those agreements that they have in the hedge funds and the banks are the reason why you see the market moving in a correction for a long time. You see the market moving in a correction for a long time is because these hedge funds are talking about the next move. The hedge funds and the banks, they're discussing whether the market price is high enough for them to sell the market because we're talking about selling the US dollar in the coming month, which is September. So, because we're talking about selling it, we cannot sell it here. So, these guys need to come together and say, let's push the market higher. And is it high enough? That's where you will see the market moving in a correction. If they decide it's not high enough, they will push it higher to the trend line level. And if they get that agreement and say the market is high enough, it is then that they will decide to sell it. The position that we're having is in selling the dollar. When they sell the dollar at this point, gold will fly even much higher. Gold and silver. Goodbye, guys. I'll see you on the next episode.